The unthinkable is about to happen to gold and silver. Jamie Dimon's shocking warning for 2026. The last time I saw conditions like this, I called my closest advisors into a room, closed the door, and told them, prepare for something the textbook said couldn't happen. That was 2007. Nobody listened. 18 months later, the entire global financial system nearly stopped functioning. I'm calling that meeting again, and this time I'm opening the door. What is about to happen to gold and silver is something the mainstream financial world has dismissed, laughed at, and ignored for the last decade, not because the evidence wasn't there, but because admitting it means admitting how broken the system has already become. And the people running that system are not ready to make that admission. But I am. Let me tell you what nobody in a suit on television is saying out loud. Gold is not just rising, it is undergoing a structural re-rating. There is a fundamental difference between a price going up and a price experiencing a structural re-rating, and most investors have never lived through the second one. A price going up means demand increased or supply tightened and the market adjusted. Normal. Expected. Temporary. A structural re-rating means the underlying value proposition of the asset has changed permanently, that the world's relationship with that asset, what it represents, what it protects against, what it replaces, has fundamentally shifted. Gold is being re-rated right now, in real time. And silver is about to follow with a force that will make gold's move look modest by comparison. Think about what that tells you. When the people who print money start buying the thing that money was originally designed to replace, that is not a routine portfolio adjustment. That is a signal. And it is the clearest signal I have seen in my career about where the people who actually control the system believe it is heading. China's central bank has been buying gold every single month for over 2 years straight. Russia, despite everything, has been building its gold reserves steadily for over a decade. Poland, Hungary, India, Turkey, countries across the emerging world are doing the same thing. This is not coincidence. This is coordination, and it is happening in plain sight. Let me be blunt. Most people are going to sit through the next 3 years watching gold and silver move, and they are going to tell themselves one of two things: either I knew this was coming and I still didn't act, or I never saw this coming and now it's too late. Neither of those outcomes is acceptable. So let's talk about what's actually driving this, not surface-level narratives, not talking points, but the actual structural forces that are now converging in a way that makes the unthinkable not just possible, but mathematically likely. There are 3 of them. Each one alone would be significant. Together, they are historic. In 2022, something happened that changed the way every government on Earth thinks about holding US dollar reserves. The United States and its allies froze $300 billion in Russian central bank assets. Whatever you believe about the geopolitics, whatever your position on that conflict, set it aside for a moment. Because the financial implication of that decision was seismic. It proves beyond any doubt that dollar reserves held in Western institutions are not unconditionally safe. They can be seized. They can be frozen. They can be used as a weapon. And every government on Earth, ally or adversary, friend or neutral, received that message simultaneously. If it can happen to Russia, it can happen to anyone. And the response? Diversification away from dollar-denominated assets, and toward the one asset that cannot be frozen, cannot be seized remotely, cannot be weaponized by a foreign government: physical gold. That's force number 1. There's a number I want you to hold in your mind: $1 trillion. That's what the United States government currently spends per year on interest payments alone. Just interest, not programs, not military, not roads or schools or social security. Interest on money already borrowed, already spent, already gone. That $1 trillion figure is larger than the entire GDP of countries like Saudi Arabia, Switzerland, and Argentina. And it is growing. Here's where it gets dangerous. The US government needs to roll over approximately $9 trillion in existing debt in the next 2 years, debt that was originally borrowed at near zero interest rates, which now has to be refinanced at 4% or potentially higher. The interest bill isn't going to stay at $1 trillion. It's on track to hit $1.5 trillion, then $2 trillion. At some point, and we are approaching that point, the interest payments consume so much of the federal budget that the government faces a binary choice: cut programs, raise taxes to politically unsurvivable levels, or do what every over-indebted government in history has eventually done: inflate the debt away. And the moment the market truly believes in its bones, that the US is committed to an inflationary path as the primary debt management strategy, gold and silver will not go up. They will surge. That's force number 2. This is the one nobody is talking about. I mean that literally. I've sat in rooms with some of the sharpest financial minds in the world. I've read every major investment bank's research on precious metals over the last 3 years, and this particular dynamic, the specific collision of forces that applies uniquely to silver, not gold, is almost entirely absent from mainstream financial discussion. Here it is: silver is the only asset on Earth that is simultaneously a monetary safe haven with thousands of years of value preservation history, a critical industrial input with rapidly growing, irreplaceable demand, in structural supply deficit where the world consumes more than it mines, and yet trading at a historic discount relative to its monetary partner, gold. Let me break down the industrial demand side, because this is where silver's story diverges completely from gold's in the years ahead. Solar energy: the global solar installation rate has nearly doubled every 3 years for the past decade. Every solar panel requires silver not as a trace element, as a core functional component. Silver is used in the photovoltaic cells because it is the best electrical conductor on Earth, and nothing commercially viable has replaced it. The International Energy Agency projects solar capacity will triple by 2030 compared to 2022 levels. That demand growth alone, just the solar sector, would absorb silver supply at a rate the mining industry cannot match. And solar isn't the only story. Electric vehicles use 2 to 3 times more silver than conventional vehicles. 5G infrastructure, medical devices, defense electronics, semiconductor fabrication, silver is in all of it. And unlike gold, which can be recycled from vaults indefinitely, most industrial silver is consumed, used, destroyed in the manufacturing process, unrecoverable. There is no recycled silver coming back to market to cushion the supply gap. Here's the number that should stop you cold: silver mine supply has been essentially flat for a decade. Industrial demand is accelerating. The Silver Institute documented a supply deficit of over 200 million ounces in a single recent year. That is not a rounding error. That is a structural imbalance that doesn't correct itself without either a significant price increase to incentivize new mining investment, or demand destruction. And demand is not being destroyed. It is accelerating. Think back to 1971. Vietnam had cost the country enormously financially, socially, politically. The dollar was under pressure. Foreign governments, particularly France under de Gaulle, were nervous. They started doing something that was entirely within their legal rights under the Bretton Woods Agreement: they started converting their dollar reserves into gold. President Nixon faced a choice: honor the commitment, let the gold leave, accept the discipline that a gold-backed currency imposes, or close the gold window, break the promise, untether the dollar from any physical constraint. He chose option 2. On a Sunday night in August 1971, without warning the world, without consulting allies, without a vote, Nixon ended the gold standard. The dollar became, in that moment, backed by nothing except faith. What happened to gold after that decision? It went from $35 an ounce, the fixed rate it had been pegged at for decades, to $850 an ounce by 1980, a 24-fold increase in 9 years. But here's the truth nobody wants to hear: the decisions being made today are bigger than 1971. And the response in gold and silver, if history rhymes even loosely, will be proportionally larger. For the last 30 years, the standard institutional portfolio, the model that every pension fund, endowment, and sovereign wealth fund defaulted to, allocated approximately 0% to 1% to precious metals. The logic was simple: gold doesn't pay a dividend. It doesn't compound. In a world of 2% inflation and stable monetary policy, it's a deadweight drag on returns. That logic made sense in that world. That world is gone. When pension funds managing $10, $20, $50 trillion in assets decide that even a 2% allocation to precious metals is prudent, the math is staggering. 2% of global institutional assets flowing into gold and silver markets that are a fraction of the size of equity or bond markets and where supply is fixed, cannot increase quickly. Mining takes years of permitting, years of development, years of capital expenditure before a single new ounce comes to market. No one is talking about what happens when institutional demand meets constrained supply in a market that is a fraction of the size of what that institutional demand represents. The answer? The price does not gradually adjust. It gaps. In 1979 and 1980, two brothers, Nelson and William Hunt, attempted to corner the silver market. They accumulated somewhere between 100 million and 200 million ounces of physical silver, representing a significant fraction of the world's above-ground silver supply at the time. What happened to the price? It went from roughly $6 an ounce in early 1979 to nearly $50 an ounce in January 1980. Two individuals with significant but not unlimited resources moved the silver price eightfold in 14 months simply by removing supply from the market. Now imagine not two wealthy brothers, but a wave of institutional investors collectively deciding that silver belongs in their portfolios. Imagine not manipulation, but genuine recognition of the structural supply deficit and the monetary conditions. Imagine the same physics inelastic supply meeting surging demand in a market where the industrial demand story that didn't exist in 1979 is today the dominant global narrative around electrification and clean energy. The unthinkable is not that silver could do what it did in 1979. The unthinkable is that it could do multiples of that. I want to tell you about a day, not a theoretical day, not a scenario, an actual day, a specific morning when the price of an asset moved in a way that made everyone who hadn't bought it feel physically ill. Not because it was dramatic, but because it was permanent. There was no dip to buy. There was no correction. There was no moment where the patient investor who waited for a pullback got their entry. The price moved, and it never came back. That is what a structural re-rating looks like in real time. Not the slow grind upward that gives everyone time to feel comfortable and participate, the sudden, violent, irreversible rip where the asset finds a new equilibrium at a level that shocks everyone who wasn't already positioned. I am telling you, with everything I know, with every pattern I have watched over 40 years in finance, that gold and silver are approaching that day. And when it comes, the window will not stay open. Here's what most people don't understand about precious metals bull markets: they don't build gradually to a peak. They have a long base building phase, often years, sometimes decades, followed by a compression release that happens faster than anyone expects. The base building phase for gold started around 2015. For silver, around the same time. We have been in that base for years. The patient investors, the ones who understood the structural case, have been accumulating during that phase quietly, without headlines. What ends the base building phase? What triggers the compression release? It's always the same thing, a moment of clarity, a moment where a critical mass of investors, not retail investors, not YouTube viewers, not financial Twitter, but the large institutional money, the sovereign wealth funds, the pension funds managing trillions of dollars, suddenly, collectively update their view of the risk. They don't need to believe in gold philosophically. They don't need to be gold bugs. They just need to believe that the risk of not having it is greater than the risk of holding it. And right now, that inflection is approaching. Here's the truth nobody wants to hear: the financial advice that protects wealth in a stable, low inflation, dollar-dominant world is the same financial advice that destroys wealth in the world we are entering. Diversified stock portfolios, long-dated bonds, cash and savings accounts earning rates below real inflation, index funds weighted heavily to tech stocks priced for a future that requires cheap capital that no longer exists, these are not bad ideas in the abstract. In the right environment, they're sensible, responsible even. But environments change. And the speed at which most investors update their frameworks is tragically, reliably too slow. I have watched this happen 3 times in my career. The people who moved first, not recklessly, but decisively, with clear eyes and a solid understanding of the forces at work, protected and multiplied their wealth. The people who waited for certainty, who needed the newspaper to confirm what the data was already telling them, paid for that certainty with a diminished financial future. Your portfolio is not safe in the system as currently configured. Not because of a conspiracy, not because of some secret elite agenda, but because of the simple, documented, mathematical reality of $34 trillion in debt, accelerating interest payments, a central bank that has already proven it will print when cornered, and a global reserve currency system under its most serious challenge in 50 years. That reality does not care about your political preferences. It does not care about your comfort. It does not negotiate. It just unfolds. And the people who have already decided what they're going to do when it unfolds are sleeping better than the people who are still hoping it works itself out. The unthinkable is simply this, that the financial common sense of the last 30 years, the world of cheap money, stable inflation, and an unquestioned dollar, is over. And in its place is something new, something the textbooks haven't finished writing yet, something that the investors who understand monetary history have been preparing for quietly, patiently, deliberately. You now understand what they understand. The only question is what you do with that understanding. Most people will do nothing. I hope you're not most people. There's a number that I want you to hold in your mind: 8 years. That is the average length of time between the moment a major monetary shift becomes inevitable and the moment the general public finally accepts it as real. 8 years of evidence. 8 years of signals. 8 years of the people who understand what's happening quietly repositioning while everyone else waits for permission from the news cycle. The shift I've been describing started in 2015 to 2016. Do the math. We are inside the window. The window that exists right now, the window between before the institutional money arrives and after, will not stay open indefinitely. The investors who entered that window have already begun. The unthinkable is already happening to gold, to silver, to the financial order that told you it couldn't. The only question left is whether you're watching or acting.